Hello and welcome to the mid-year review. My name is Theo Vandermeer and I'm joined by Bob Robotti and David Kessler. Before we start, I have a quick disclosure I'd like to read. Robotti and Company Advisors, LLC is not providing investment advice through this material. This presentation is provided for informational purposes only as an illustration of the firm's investment philosophy and shall not be considered investment advice or a recommendation or solicitation to buy or sell any securities discussed herein and does not contain enough information to be considered a recommendation or a research report. With that out of the way, I would just like to say that we want this to be an interactive experience. And to that end, we have a chat feature in today's webinar where you can submit questions as Bob is presenting. We hope that as your questions arise, you will submit them. And then at the end, David and myself will host a Q&A where we can hopefully get to all the questions that have been submitted. If we can't answer any live, we'll be sure to reach out to you directly and answer them one-on-one. With that, I'll turn it over to Bob. Bob?
Thanks, Theo. Appreciate it. Hi, I'm Bob Robotti, Robotti and Company Advisors. The purpose of the call today is what we think is going on in markets today, which we know have been extremely volatile. I guess that's a euphemism right now for they've declined precipitously. How did we get here? I think it's particularly relevant, especially at this time in terms of what's happened and what's led up to the environment that's leading to the changes in dislocations. And then the last piece is, of course, from here, what do we expect is to come and what's our view and where are we positioned? So the first thing, so here I'm going to tell you the answer to these questions. The first question is, well, who the hell am I? Do I know what I'm talking about? And, do we have good judgment? So therefore, it's worthwhile to listen to our thoughts. So I founded Robotti and Company about 39 years ago. I did that with a number of other key friends and family and a couple of key people, most notably Joe Riley, who himself was one of the founders of Tweedy Brown. So our avocation, our love, our passion is really in picking stocks. And the firm was born with that. Actually, it predates our birth. We are genetically predisposed to be interested in bottom-up stock research. That's the critical part of how we think about things. And for myself, that's true even when I was in college. I guess two of my favorite courses were cost accounting and microeconomics. So therefore, understanding businesses, looking at businesses. And that's what we do. The research we do, we have informed opinions on specific companies, therefore understand the industries in which they are, and therefore understand some portion of the economy and what role they play, and have an increased likelihood that we understand the dynamics that will drive future success of those businesses. Today, there's 14 people actually who join me, who their passion also is they live to find stocks, to pick stocks that will outperform the market. And of course, that's the litmus test. We do all of this with the intent of outperforming the market. I can say that our flagship investment strategy does that. Recently, we again outperforming the market, but more importantly, over long term, we have definitely substantially outperformed the market. And so, we do think that that's an important component. What I'd also say is, in addition to the research we do, one of the things is companies that we tend to have a long interest in, and that's most of them, that we occasionally do get more involved with the company and have a seat at the table, and that is play a role as a director in some of these companies. We think that also is informative for us and extremely value added in the totality of our investment approach. And what I would point out is this accumulative knowledge and information that continues to compound. So we talk about compounding capital, but of course, it's not just compounding capital, it's compounding the knowledge experience that we do have. And that's a critical element, we think, that continues to increase the likelihood of success in the future. So first, I want to start, where are we? How did we get here? This is particularly critical today, we believe. So having done 39 years of having the firm, and prior to that, right, the 4 years that I met the people at Tweedy, was introduced to investing through the people at Tweedy Brown. And then the 3 years I spent working for Mario Gabelli, that's almost 50 years of investment experience. And so you have to understand a critical thing is what's a cycle and what is a structural permanent change. And what you have had in the last decade plus pandemic, so more than a decade, is you've had relatively linear progression of certain things. So that's what you think we have, this myopia of linear thinking that continues to have people think that because something's been a trend for a long time, and that we think potentially the end of a cycle gets construed as something that's a permanent structural change, right? A couple of years ago, you regularly heard the idea that inflation, no inflation, low inflation, that's the new norm. And so, governments have figured out how to eliminate inflation. And of course, then the backdrop of what had happened to interest rates over an extended period of time that made sense. That said, we point out it was 2011 letter, 10 years ago, that Buffett went on out and indicated that fixed income bonds were priced, critical element, priced, valuation matters. They were priced to be a return-free risk. And so we think that's interesting. But also, that's 10 years ago. What have you had happen since then? You've had this anomaly of a very tepid environment, government activity, and also occasionally something happened that got investors concerned. And so you've had this 1-2 punch that we do think that suppressed rates dramatically. So something would happen, the investors would flee for safety. And so fleeing for safety is buying treasuries, US treasuries. Of course, when the price is at a point, the safety that you get from that security is substantially mitigated, if not eliminated. And then what would follow shortly thereafter is that you'd have government policy, the Fed, stepping in and buying those same securities, further suppressing rates. So what you have is a decade plus of rate suppression, and therefore that's had a huge impact on all capital allocation. What's the risk-free rate of return? So it's had a huge gravitational pull on where capital is invested. So, we would point out the idea that inflation is dead, maybe have been a premature prediction a couple of years ago. Of course, what's different today? And so that's what we do think, that there's something that's happened in the last year that's changed potentially the perception, the beginning of the perception. So you clearly have had an increase in inflation. Now, there's plenty of people who will tell you that's transitory. Maybe the idea that the transitory nature of it is diminishing some. But anyway, what you really have had is the fixed income market and everything that is yield related, because that's what it is. It's like, how do I get yield and what do I do to do that? Given the inflation rate, those securities clearly on a purchasing power basis are losing money today. And so the question becomes, does something happen to that repricing? Not only those securities, but everything else that kind of falls from what's the risk-free rate of return. So here's the idea of a capital cycle and kind of where things are. And this includes, of course, securities themselves, right? And so, but of course, these are not linear. And the timeline, it's not linear, and the movement and direction is not a linear function. And what we really have had, we do think, is this odd decade. So the graph below is a pretty crude concept, but the idea is you've had multiple recoveries and therefore not had the full cycle and the decline. So therefore, that also has fed the idea that this is the new norm and that therefore things have structurally and permanently changed. At the same time, the other side of the equation is what's done well and what's pulled capital and what's been attractive and what's performed well. It's also where does it pull capital from? And that's what we think, of course, the real opportunity is. Where has it pulled capital from and how long has it been? And so it kind of matches in terms of it hasn't been a linear timeline and it's been an extended downturn that's actually happened to companies and therefore provided an opportunity in a base that's an extremely low level. So we all know the phrase, past performance is not a predictor for future success. But it seems to me in large part, capital and the close of capital have almost forgotten that. And it makes some sense because, you give people 3 to 5 year time frame. If you don't outperform, then therefore there must be something wrong with that investment process. And the decade was an abnormal decade. And that's what it is. It was post the financial crisis, the response of governments to try to stabilize and improve the economy led to a very unique decade in terms of economic activity. So it does seem to me as if people forgot the idea that past performance is not a predictor of future success. Today, capital is invested in things that have clearly been the past successes. The next decade, we wrote it 2019, we think would be vastly different. You see that every 10 years, if you look at what the best performing stocks are, which sectors are the best performing stock, you see there are rotations in the economy, different things happen. And the presumption, of course, of this decade was it would be the same as the last. We didn't think that was be the case. The fact of the matter is the onset of the pandemic did kind of delay things and kind of keep us in that, and therefore reinforce this idea that, no, this is the new norm. And of course, in an interest rate world of 1%, the idea that you would pay 30 times earnings is totally logical, right? A 3% yield that's growing over time clearly is better than a 1% yield. So Valuation, therefore, was, we think, potentially distorted by the fact that the reference rate, the risk-free rate of return, was suppressed for a decade. And a critical thing we do think is there's plenty of information and data that suggests, and therefore so much capital today, when you read an article, it will tell you the last 3 times this happens, this is what happens, and this is what follows. Patterns are of interest, but you have to look and say, are the facts underneath it, lying it, and the presumptions the same? Is there something different? So information and data is no substitute for thinking, and that's what you do. We think if you think through and look at the facts, you come to a different conclusion maybe than the historical pattern. So what we do, right? What we do is we focus in on cyclical businesses. And the reason we do that is that in a difficult time in an industry, you can identify companies that are differentiated, that are well-run, that are the beneficiaries of that difficulty, but you can buy those businesses for a substantial discount to what it would cost to build that business. A critical element, of course, is would you want to build that business? Is this a critical product that they're producing, service they're providing, that therefore, clearly has a future? So if you've made that determination and you've identified a company, we think that you can therefore have an entry price into something that's substantially discounted and has excellent growth opportunities, and you buy it for a fraction of what the intrinsic value is. The intrinsic value, of course, being what the discounted value of the future cash flows of those businesses are. But again, it's not necessarily linear. We're reminded of the theme song to Friends. It's like you're always stuck in second gear when it hasn't been your day, your week, month, or even your year. And so that's what we would think. So for industrials, many of them US-based industrials, materials, energy companies also, we think it hasn't been their decade. And so therefore, that's been one of the things. The economic environment that existed is a critical element in the realization of the earnings and latent earnings power of those businesses. And if you don't have an environment that provides the ability for them to manifest those latent earnings, you don't see them. You don't see them, you sell the stock, you move on, it's a value trap. We don't think that's the case, and we'll tell you why. So that's what we have. So what we see in many of these companies is that we see the revenge of the old economy. We see basic industrial companies that, due to an extended period of time of poor performance, have had the capital not reinvested in these businesses. Therefore, you've had competitors leave the businesses. You've had downsizing, right-sizing of those businesses. You've had repeated rounds of consolidation, so that there are many fewer players today. And those remaining players are extremely well-financed, well-run, well-managed, and there's a limited number who are rational, reasonable competitors. And in many cases, we really think you structurally change that business. And we think we've structurally changed what is the historical cyclical pattern of many of those businesses. And that's what we think. And that is what we also see happening today. These businesses, because of that new competitive situation with a limited number of rational competitors, has what's identifiable as pricing power, because there's a barrier to entry in the business, and therefore have the ability, even in a rising interest rate environment, to more than raise the price of their product, to expand margins in what would otherwise be a difficult environment. We think demonstrated these are not cyclical businesses. If you can do that in a rising cost environment, you can raise the price of your product, given the competitive nature of your industry, and have increasing profits, it really is a manifestation of this fact that something different has happened than historically had been the pattern for that business. And that's what we say. One man's pricing power is another man's inflation. Part of what you're seeing in inflation today is not supply chain issues, therefore transitory, temporary issues, but no, a number of these industries that really have downsized, and the structure of it is different. And you have 3, 4 competitors who are reasonable, rational, extremely well-financed, who have pricing power and are exercising the logical way to run those businesses and maximizing returns and profits. So who's looking is part of the problem. That's why we think there's this opportunity, right? Because even many people who are value investors, we think, have migrated how they interpret value, right? Everyone has hung, a lot of people in the value community have hung on, Buffett's acknowledgement that a better business is one in which it's to pay a fair price for a better business is potentially a better investment approach than is to buy a cheap business at a cheap price. There's no doubt about that. That's an accurate statement. Valuation is relevant. What's the price you pay for that better business? The other thing is, are some of these businesses that were perceived to be poor businesses structurally changed, and that's what we believe to be the case. So as a result, many people, including many value investors, no longer invest in cyclicals. They won't invest in anything that's a commodity type business, because of course it's cyclical. Here's another data point we think is interesting. They won't invest in companies that have a levered balance sheet. And of course, we all know why that is. You don't want to have leverage. Leverage potentially is the enemy of equity, especially if you're investing in cyclical businesses, because at a down point in the cycle, the debt becomes potentially a huge negative, because it potentially is a game over for your equity. Today, I think you have to do a lot of work and think about that, because debt markets, we would note, first off, interest rates are extremely modest today, but more importantly, there's a lot of subordinated debt today that has relatively covenant light or no covenants. And therefore, the nature of the debt is benign, and therefore gives potential added benefit to the equity owner without the detriment that normally comes along with that. This is stock specific. Do your research, understand the company, but potentially that leverage is a low-cost way to improve the earnings of that equity. The other thing is, again, since the investments that we made in home building related businesses had gone through the worst depression that business had ever had, there's radical changes to those businesses. When recovery started, it's a very long period of recovery that therefore is in front of these businesses. So therefore, just because the stock doubles and triples, the idea that it doesn't hurt to take a profit, or you don't want to buy it because it's trading at a 52-week high, we think those are potentially reasons that people aren't taking advantage of the opportunities that we see are clear and obvious. And we would say, as a highlight, right, the investments that we made, especially in the distributors and some of the products in the home building business, if we had sold out when the stock had doubled, tripled, and taken our profit, that we would have left huge amounts of money on the table, right? Because these companies have had dramatic improvements. The businesses have changed. The structure of those businesses have changed. The earnings power of those businesses is different. And the upside and return potential is dramatic. And therefore, that's an interesting data point to make a determination, do you want to buy a stock or not? And clearly, if you listen to what we're talking about, we're investing in businesses that are different than what the market is. So, Templeton, of course, we all know this comment that to perform better than the market, you have to do something different than the crowd. There's no doubt about it. We think that we're doing something different than the crowd, and other people have migrated away and are not paying attention to the opportunity set that we think is available today. And it's clear and obvious. So to outperform the market, which we've done and which is our goal, you have to have an edge. So what's our edge? So I would suggest to you that our behavioral edge is extremely important. That's the differentiator. And what that is we take a long-term view and have the ability to tolerate market swings. Well, first off, for us, A, it's always true given the nature of what we're investing in. B, it's particularly true at this juncture in market activities. So the first one, if you're buying cyclical businesses that are in difficult positions, it's not we buy it at the bottom and from there it's straight up and linear positive. That's not the case. We know that. And therefore, in the short term, things potentially work against you. Developments happen you wouldn't have anticipated. And therefore, there's issues with the company and the valuation potentially declines, and it becomes a more difficult situation. You have to understand the business. You have to, of course, appreciate the facts. If you're wrong, that's one thing, you move on. But if you're not, the market is giving you a huge opportunity, right? Because you get the ability when something has happened adverse, and adverse may mean that it may be adverse in the short term, but not in the long term. And it's clearly going to give you a lower entry price point to invest in that business. So therefore, to take advantage of those opportunities when things in the short term work against you, given your conviction and understanding of the long-term opportunity, is a critical element of what we do. The second reason for behavioral edge is, it is important today, given a decade of underperformance. What really has happened, people have given up on, we think, these really interesting companies with a very dynamic situation with valuations that are extremely attractive. So therefore, more than ever, this is true given that extended period of underperformance. The second thing we'd say is we think we have an information edge, right? The information edge that we have is given that time horizon, given that perspective. As I said, frequently the news that permeates the availability and therefore people's attentions is what's happening in the short term. What happened to this quarter? What happened to pricing? What the outlook is in the next quarter? So that gravitational pull to look at short-term information affects stock prices. and therefore gives opportunity. But our focus being on, okay, that piece of bad news that definitely hurt last quarter's earnings, we think is an element that actually increases the earnings potential in this business 3 to 5 years from now. So in the framework that we're looking at it, we think that's good news and good information and a positive development. At the same time, what that's done is discounted the price further. So therefore, by focusing in on the right information and by analyzing it in the right time horizon, and that is not the next quarter, not as next, even the next year potentially, but in the next 3 to 5 years, you can better understand and put it in place and provide a thoughtful opportunity to further invest. So that's what I'm saying. I'm thinking that there's been this extended period of underperformance, discounts, and structural changes, so that therefore that's providing a very different position for these companies. Right. What it also is, we did talk about the cycle. And of course, the cycle is once things get better and the earnings improve, which they have today, that therefore the high prices, the cure for high prices is high prices. And so that therefore that begins the next cycle, the next oversupply, the next decline. But we think there's reasons to think there's a significant amount of sustainability for 2 reasons. Because that's what it is. High prices bring there's a cure for high prices because that means high returns. High returns means new capital come in. New capital comes in means new supply. That means oversupply, therefore down cycles. So one, we talked about industries where there are today 3 competitors that are well capitalized, thoughtful, and will moderate production, and therefore keep pricing and profitability even in difficult situations. So therefore that gives sustainability given that structure of that industry that you have today. Secondly, the barrier to entry for who's the new participant who might come in seeing these great returns is there's a hurdle. And the hurdle we think is the environmental impact, because industrial type businesses tend to have more environmental impact. So the idea that you want to start a new chlor-alkali plant. One of my investors is a chemical engineer. He looked at chlor-alkali and said, oh my God, that is a messy business. So the idea that you want to get into these businesses is problematic. And so therefore, clearly that's the case in energy, fossil fuel investing. The idea that you want to invest in a fossil fuel has all kinds of the structural hurdles. And you see that. You see great reluctance to normally cure that high price, high profit cycle by new capital coming in or incremental capital from the current investors. So we think that there's reasons to think that there's a sustainable period. Of course, nothing's permanent. Nothing will be etched in stone. And therefore, eventually, high profits, high returns will actually bring about changes. But we think there's reasons that that's substantially mitigated. And therefore, the opportunity of the profitability of these businesses is actually something that you are at an interesting point in the ability for sustainability. So, okay, so what if we're wrong? What if there's a slowdown? There's plenty of reasons, right? One of the things we clearly are saying is that interest rates are wrong and that interest rates are beginning to readjust to what the real inflation rate is. And therefore, they probably find some new equilibrium, we think higher than where they've been. And so therefore, that means mortgage rates are up. So, here we are investors in the home building business. Clearly, that is a headwind to the business. That is a factor to consider. We're not blind to that. We realize that. The fact of the matter is that, again, the grassroots macroeconomics, right? And that's what we talk about is understanding these businesses and the industry structure and the drivers mitigate, we think, many of these issues, especially given the consolidated nature of these businesses. Because what do you see these businesses doing today? With that excess free cash flow, what they're not doing is they're not building new capacity. So they're not killing the goose that's laying this golden egg, and therefore they're being extremely intelligent with allocation of capital. What also has happened is in the last year and a half, the free cash flow generation of these businesses has been dramatic, where even some that were relatively highly leveraged 2 years ago today have many cases debt-free balance sheets, have generated excess cash. And again, with that excess cash, not new capacity, they further consolidated the businesses or they bought back a substantial amount of stock at a very discounted price because the market doesn't believe anywhere near that there's sustainability to these earnings. We agree with managements who, of course, understand these businesses, we think well, and the remaining players in it are thoughtful, rational people who understand capital allocation. And so therefore, there's a huge opportunity to further increase the earnings power of these businesses. The margin of safety that you get given that cash flow, those strong balance sheets, the consolidated nature of this industry and the rational way to compete with slowdown in the businesses make these businesses very different and much less risky than one perceives. So, and we would point out, even in a recession, should there be one that comes, that you do have things for these physical, tangible things. You need wood, you need chemicals, you need energy, so that there's more persistency to the demand, even in an economic recession. So again, we talked about an extended period of time where the winners have been the same winners. And yet we have seen through our research, understanding our companies, a lot of dynamics that hadn't manifested themselves, but lead us to believe that there's a different economic reality that is approaching, that we were there, that we thought would have happened even sooner. And so I'm reminded of this comment here: things take longer to happen than you think they will in economics. And they took this last decade plus 2-year pandemic was an extremely long period of time. But when they happen faster than you thought they could. That's what's happening today. There's a substantial change. It's happening quickly. People hope, they are in denial, saying that much of it is transitory. Some of it is transitory. Some of it is more a return to a more normal economic environment and therefore sustainable. And you're only beginning to see capital move. Capital hasn't moved. Capital needs to adjust the new changed economic underlying environment. So all of you know, right, we've been long-term investors over 50 years in oil and gas, so fossil fuels. So the first observation we would have is the demand today for energy in all forms is strong. And therefore, that is a critical element. And as part of that, we clearly understand the drive for renewables. In that context, that means higher prices of all energy forms, the demand for energy will accelerate. New energy, renewable energy being an increasing part of the equation. Absolutely no argument on our part that isn't the case. The fact of the matter is the grow out of the renewables itself requires a lot of tangible physical things, steel, cement. So therefore, the implementation and the build out of the renewable portion of the energy grid is a key component that will drive a lot of these industrials to be in extremely favored positions with strong demand for their products. At the same time, what we also see is that the need for existing fossil fuels is there. The second point I'd like to make on energy, we're all aware and we all know of oil prices. Oil prices are up, we see that. And as North American residents, that's a focus that we have, and we miss the totality of kind of energy demand, right? The fact of the matter is, in the rest of the world, natural gas and coal are two forms of fossil fuels that also are in strong demand. And this, of course, people confuse the Russian invasion of Ukraine as driving many of the things that were inflationary or energy related. And in many cases, we would say that's wrong. It's a year ago that the strong demand for energy in all its forms was causing significant changes and cost pressures in Europe. And so therefore, that's what's happened. Of course, Europe and Asia have substantially increased their consumption of coal to be able to meet the electric needs of both of those locations. And so therefore, the continued electrification is just another example of a build out of physical, tangible elements that require a lot of these industrial products that we're talking about. And so that is another element. What we also identify is a lot of the industrials that we are focused on, are North American based. And therefore there is a difference, right? And that is North America has a sufficient and surplus supply and availability of natural gas. And so natural gas prices in North America are disconnected from the rest of the fossil fuels around the world. So Asia, Europe, the prices for coal and natural gas exceed the energy equivalents of oil. They are today in demand to a point where the prices exceed oil prices. So it is not an oil shortage, not shortage because there's enough oil to meet the demand, but strong oil markets that therefore are affecting pricing. It's energy broadly. So these other things in the rest of the world are driving a lot of what we see as a critical element for where there are profit opportunities that are not being recognized today. And so, and that's not just in energy companies in the US, which we do think is one of the places that's a beneficiary, but there is all these industrial related businesses are energy intensive. Many of them use natural gas as a raw material. They have a huge advantage. So if you're making chemicals and fertilizers in the US and you're using North American natural gas at a third, a quarter of the price of European natural gas, European coal, Asian natural gas, those are the marginal producers that are setting the price point, that North American producers have an excess profit margin they're capturing, giving their huge cost advantage. So, there's a number of the chemical and fertilizer companies that are, we think extremely interesting investments today that are part of the beneficiary of this North American natural gas advantage, energy advantage. As all of you know, we're investors in the home building business, right? We did that when we entered at really low points in the cycle. These are discounted valuations for these companies, and it took a long time for the business to recover. And that's what happens. We invest sooner than we anticipate, than we think, then it probably is the bottom, because we see the longer term opportunity. And where's the bottom and where's the right entry point? We're not going to wait for the optimum low point. We're going to invest where we think there's an excellent opportunity. And the market frequently gives us opportunities then to invest capital as we continue to develop the investment thesis and therefore have more conviction, and the dynamics in the business continue to improve. And that's what you do see. You see consolidation, you see right sizing, you see companies that have differentiated products, then outperforming others. And therefore, those are the opportunities that we've identified and we continue to invest in. So today, the investments that we have are home building related in the United States. They definitely have been detractors from performance in the first half of the year. You've already seen the market concerned about higher inflation or higher mortgage rates. Clearly, that slows the business down. There's undeniable. But we think as the market is giving you a great opportunity to invest in these businesses, if you look at the underlying fundamentals of the business, the longer term supply demand, because the key element here is demographics. People need a place to live. Those demographics are what drive home building activity. And yes, there'll be a moderated period here, a quarter or two, where things will slow down. But again, the strength of the balance sheets, the consolidated nature of the business, the ability to moderate production to therefore downscale if there is reduction in demand, those are all things that mean there's a huge margin of safety, even in these periods of time where there's a slowdown. And we think there's a dramatic opportunity. So for example, Builders First Source, right? It's been a great investment for us today. I haven't fallen in love with the business other than the fact that it's a wonderful business that's very different than it's historically been, and it holds a competitive position that people don't fully appreciate. That with a product offering that's different from its competitors, a product offering that is critical and therefore is adding extra value to its customers and therefore differentiated. So those are the elements that mean this is a great investment today, and the valuation, the multiples, the single-digit PE, generating a significant amount of free cash, buying back stock, increasing therefore the earnings power of these businesses. These are great times to be invested in these businesses. Graham noted Horace's poem, right? We shall see the restoration of those that have now fallen, and many shall fall that are now in honor. That's what we think. The volatility going on in the market is the beginning of a huge shift where the economic environment that is going to be positive for companies today is different than the economic environment that existed. The winners today are different than the winners in the past. There are plenty of other companies and a lot of companies that have come down dramatically. I'm sure many of them are interesting opportunities today. That's not the focus. We don't need to go look someplace else because the universe of companies we're aware of is more than the capital that we have to invest, and therefore there's plenty of opportunities to invest in businesses that we have high conviction, understanding of the business, valuation matters, valuations that are extremely interested and substantially orders of magnitude cheaper than where most investments are valued today, and the discount rates apply to those. So that's what we think. Valuation matters. What you're seeing is many of these old economy companies have gone through an extended period of time, and there are structural changes to these businesses that therefore change the nature of that business and the sustainability and the growth ability of the earnings of that business. And then what drove that? The myopia of linear thinking. A decade plus 2 years of the same thing working, the same economic underlying environment extended for a period of time has gravitated capital to be invested based on that past reality. The things have changed, and we see that today. We know that inflation has changed. We know that there are critical elements that are different today. Most of the capital world is in denial on those things, and therefore the capital is only beginning to move. The other thing is, as I said, it's the revenge of the stock picker. You got to understand the company that you're invested in. You got to understand the business invested in. You got to have those factors to know that the investment you have really has gives you this opportunity to outperform the market. And what we're at today is it's a unique time actually in my investing experience. So right, here I'll be 69 next month. So I've been doing this, as I said, for 50 years. And what you really do see is that these businesses, the transformation of many of these old economy businesses are really better businesses with barriers to entry. That means sustainable and higher returns on capital that you don't perceive with these companies. The myopia of linear thinking has given you the opportunity, and that's what it is. So you can buy better businesses, Buffett's better businesses at Graham's valuations, single-digit PE multiples, when you do have a 3% treasury, so a 33% earnings yield. So a huge difference. So that's what we think we're at today. So with that, I'll close with my prepared comments. And Theo, David, if there are questions, please.
Great. Thanks, Bob. So our first question is about inflation, and it's, are you specifically hedging out inflation, and how are you protecting your investments from inflation?
So the key critical element, we all know, the way to protect against inflation is to have pricing power in the product that you sell. And of course, that's what we really do think, right? We're identified these businesses that have structurally changed the nature of the business, and therefore have a limited number of competitors who are rational, reasonable, and will moderate production to that and have pricing power. So for example, the best example we actually, perfect example is Olin. So Olin is a chlor-alkali manufacturer who actually, of course, we're also invested in Westlake Chemical, a competitor of theirs. And so that industry, first quarter earnings, last year they said they would earn $10. And the market clearly doesn't believe it. The stock trades today in the mid 60s and it's probably traded up quite a bit over the last 6 months, but it's still 10 times earnings, $65 a share. It doesn't seem as if that kind of correlates. What did they do in the first quarter? They earned $2.50. But it wasn't the earnings that were relevant. It was the underlying facts. The first fact is they had reduced volumes in the quarter. So again, if the end market demand isn't there, they moderated production to meet the end market demand. Second thing is they had significant cost increases. So that this demonstrates to us better than anything that this is no longer a commodity business. Any commodity business in a situation where it sells less volume and sees higher costs, you see earnings fall through the floor. What happened to earnings is margins expanded and profits improved. Not only did they have the headwinds of less volume, higher costs, a number of the facilities had problems and therefore were out and therefore weren't operating. So the earnings over the subsequent quarters will probably continue to trend up. So here you have a demonstrated fact where the way to fight cost increases is you got to have an industry structure and you got to have industry competitors so that you have pricing power, because pricing power is what will be able to maintain margins, even a rising cost environment. And there's no way to get from a rising cost environment, we believe today.
Great. Second question we have is, how can you be sure that some of the industries, such as housing, for example, are just benefiting from a COVID bump? And conversely, how do you know that some of the companies that are potentially going to be the fallen aren't just being affected by, say, the invasion of Ukraine or some other one-off event?
I don't know. So you've got two. So let's digress to the second one for a moment, right? Because there's people forget timelines. A lot of the elements, all the elements we're talking about in these businesses were clearly underway long before Russia invaded Ukraine. And so therefore, yes, the Russian invasion of Ukraine has exacerbated some of these issues. And therefore, and we do think that is transitory. Hopefully it'll be shorter transitory as opposed to longer. And so those things will kind of correct. But the underlying demand, supply, profitability of these businesses was demonstrated before you had a Russian invasion of Ukraine. And so therefore, those elements of supply and demand were already there. Clearly, some of what we think is, if you look back over the last decade, many of these businesses really did have growth in the end markets of their products. It was tepid growth, 1-2%, so it wasn't dramatic. But we even thought the end of 2019, there were a number of these companies that were close to a tipping point. Of course, you had the interruption of COVID that happened. So what you do have is since then, of course, the recovery and mobility again means you're kind of back to where you were. So there isn't some bump that really is kind of, we think that's kind of come from that. And of course, what's also happened is the government has changed its response or incrementally added a fiscal response in addition to a monetary response. So therefore, instead of suppressing interest rates, which of course, I'd say the Fed was ineffective, right? The reason it suppressed interest rates, and that's what it was rate suppression, was to stimulate the economy. That was an ineffective policy. What was that? A trickle down kind of concept that therefore, if you gave more money to financial assets and they appreciated somehow, that would end up moving into the economy. So that didn't work. So that was an unsuccessful process. So instead, you do have fiscal policy, right? We are going to build bridges and roads. I think that's undeniable. It's going to happen. That means tangible, physical things are going to be needed. And so therefore, the companies we're invested in are clearly going to be beneficiaries. And so therefore, the government policies are different today. And therefore, we think, and definitely adding something to end market demand. But of course, you could see a slowdown in that. But again, structure of these businesses are different than they've been. So we think there's a mitigated issue with that one. What was the first one, David? The first part of it?
He's muted, but I think the first thing was about the COVID bump. But I think that you kind of hit that COVID more unlocked the potential that was already there more than caused a change in itself.
So most of what I think is going on, well, I hope most of what is going on in Russia today with its invasion of Ukraine is transitory, right? That we will be past that at some point. But one of the things that process has emphasized to the world comes to energy, right? And so the reliability of where you get energy from is something that we think is really permanently etched in people's understandings today. And so we think that that's an interesting dynamic. What we also think is that creates it's not the short-term fact that maybe there's a little less oil and gas that people buy from Russia, because that is a transitory fact. It is the idea that capital reinvestment, because that's what it is. Every oil and gas well depletes and therefore needs new capital. And so therefore, there definitely will be a reluctance to put new capital into Russia. There's definitely going to be the need to put new capital into Russia. So what happens to the productive capacity for oil and gas in Russia 2 to 3 years out is an interesting question that we think is of interest. But more importantly is I have to work to getting a secure, reliable source of those fuels. And I don't have that today. And so that's an interesting element that adds, we think, extra positives to a number of the investments that we have.
Right. So our next question is about investment demographics. So does the age or the investor demographics that you have impact your investment strategy? So say a 50-year-old versus a 7-year-old.
So did you say 50 versus 70 or 50 versus
50
70?
versus 7? 50 versus 7.
We're only looking to invest the capital that somebody has to invest for an extended period of time. And so therefore it doesn't have the need for that capital. So therefore someone who's 50 years old, may have capital and have different components to it. What do they need to pay the bills, pay the mortgage, pay the kids' college and all of those things? And that's something that shouldn't be invested, we think, in equity markets. So the component of it that is longer term in nature that can be invested in equity markets. Therefore, the capital that we're involved with, we hope and expect and we know really has a 3 to 5 year time horizon on it, if not longer. And so therefore, the way we would invest it for 7 years, we're not differentiating our investment for those different groups that maybe doesn't make sense for a 50-year-old or may not make sense for a 7-year-old. But we're looking for longer term appreciation. And so that's the mantra in which we look at how do we invest. And if that ties in with someone else's capital or the component of the capital that they can invest that way, we think that's a good match between them and us.
The only thing I would just add to that, Bob, is that we do take into account demographics for taxable versus non-taxable accounts. And so there are slight differences we'll do in managing those type of accounts.
Thank you, Theo. Yes.
Great. And just a reminder, if you have any questions, please type them in. Right now, I think this is our last question, but the question is, what cyclical industries are still bouncing along the bottom that continue or do look interesting to you?
Which ones are still at the bottom? I don't know. I'd have to think of this. We're not looking for new ideas to a certain extent, right? I think we have a multitude of opportunities that far exceed the amount of capital we have to invest in businesses that we think are already at that point. Now, of course, what I do think is still bouncing along the bottom. A number of the energy things that we're investing in that relate to offshore activity, we think are still bouncing along the bottom. And we think that the opportunity, that said, we think it's been clearly manifested in recent months that those businesses are in very different positions today. And you started to see the demand radically change and accelerate. And so therefore we think that they're still close to the bottom. And we think that there's substantial upside. And that's what we do think. You know, the analogy would be many of those investments we think are the same place Builders First Source was in 2012 and 13 when he started to see a beginning in housing recovery. But the nature of that business had changed. It continued to develop and change, and the growth in the business that from the recovery was dramatic. And so that's what you do see today. So those energy investments, it's at that tipping point we think that's been reached, but there's a long way of recovery from here.
And again, you can correct me if I'm wrong here, Bob, but I think there's a difference between bouncing along the bottom of opportunity and market price. There are some things in the energy sector even that are probably close to 52-week highs that I would say are close to the bottom of the opportunity set that's in front of them.
Yeah, I would agree that I can think of a couple companies that are 52-week highs, but I think have a very long runway of opportunity from here. And the cash flows that I can envision in those businesses is dramatically greater than the market capitalization of those businesses today.
Great. So we have another question here that's about the housing market. How do you think rising interest rates will affect the housing market and the companies that we're invested in?
Yeah. So it will definitely slow down activity. That said, there's a number of points. The first one is the supply of homes we think is extremely modest for the existing demand. So, you know, the time you put a home on the market is extremely modest before it sells today. And it gives an indication to the demand situation and the limited amount of supply. So therefore, slowing down the demand part of the equation, you didn't build up a lot of inventory and supply, expecting all of this new demand and demand growth. And so therefore, that moderates the risk. And what you look at is in the chain of each one of these companies, so the products that are made, the distributors who have them, you know, is there inventory that gets backed up in the process? And we think that there's extremely limited inventory along the line, whether that's the finished home, whether that's the building material to build it. And so therefore, that again moderates where it is. We also think that those industries have a limited number of competitors who are rational and reasonable, and therefore will moderate production and are moderating production, identifying some slowdown in activity. The financial situations of these companies is dramatic. And so what you really have is, we think there's both a company opportunity and an investor opportunity. When the business slows down, these companies have financial positions that enable them to be opportunistic. That's what you want. You want a well-positioned, well-financed company in a slowdown who can be opportunistic and continue to add things that will add earnings power, continue to consolidate those businesses. And you see that in a number of these companies. So therefore, and at the same time, it's giving investors, whether you're an existing investor or potentially a new investor, an opportunity for an entry point with one of those slowdowns in activity where the valuation still is vastly lower than what the identifiable cash flow generation capacity of these businesses are today. So it's company benefit and it's investor benefit. So therefore, the slowdown is something that happens and gives opportunity.
Thank you. We have a question about an individual stock. First is, why has Subsea lagged most energy stocks? When will that potentially change? And then in terms of thinking about valuation, do we have a price target, or how do we think about it being discounted?
And that was the two questions on Subsea 7, is that correct?
Correct, yes.
So the first one is, again, their business is focused on offshore oil development. You know, that's been the piece of the puzzle that's been let me correct myself, offshore oil and gas development, right? And so that's because these are substantially large projects that are long dated in process to execute. That meant that this is the last part of the capital cycle where people commit capital to, because you need conviction on the sustainability of the price. I commit to the project today. I commit billions of dollars. My first oil comes in 3 years' time. I need to know what the price of oil is, not today, but 3 years from now. Given the price of oil, given the price of natural gas, given where things are, the major oil companies and the national oil companies clearly have conviction that the 3-year number is going to be extremely economic. So therefore, those projects are being sanctioned today. The greenfield ones take longer, given the timeline and given the amount of dollars associated. What I think, of course, you've already seen a pickup in Subsea 7. So, finally, over the last, quarter or so, it's actually started to move. And the fact that the stock is and the earnings predictability or calculability of Subsea 7's earnings is difficult, because that's what it is. There are multiple contracts, and it's the overlay of those contracts. It's the execution of those contracts. It's the change orders that happen in those contracts, which you don't know until the second year, that therefore drives substantial amount of the profitability. You can see that from the historical pattern where earnings were when the last time the industry was in strong position. In the meantime, the company itself, right? If you looked at the competitive industry landscape there in 2014, there were 20 competitors. There were new entrants into the business. Right, Goldman Sachs backed a company called Siona. They got top managements from all the companies. They built a new vessel. The company never got a large contract, and so therefore it's gone out of business. So therefore, the winnowing down of who the competitors are. And today you have two differentiated competitors: TechnipFMC and Subsea 7, in an alliance with Schlumberger, offering products and services that are differentiated from the rest of the customers, creating its own barrier to entry, creating improved profitability potential in these businesses that will take a year or two to manifest. The other part of it is no one wants to, everybody wants to invest in renewable. And the fact of the matter is, Subsea 7's business is being transformed, right? They've taken the assets that are in the oil and gas business, and they built out this business that is installing offshore wind, which is having dramatic growth to it. Right, they then consolidated their offshore wind business with another existing company to have a full complement. So they install the platforms, install the towers, run the cabling, run the electricity to shore, and now in ships that install the turbines at the top of the tower, so therefore can do a fully integrated project. That is a dramatic business that has dramatic growth to it. That is also, part of the green energy solution. So therefore, this company, in my mind, that's one of the great opportunities today that probably exists. Now, what I think the earnings power of that business is harder for me to calculate. I will admit that, but I do think that the earnings power of the business is dramatically higher than where it was at the last peak, and it earned 250 or so. So I think the earnings power is very high from where it is today. It will take some time for investors to have conviction. What's also happening, though, is the pipeline of business is filling up, and I have reasons to believe that will accelerate, especially given what is going to happen is brownfield projects will continue to populate themselves. And so that will then fill in this period of time where they've identified for the next year or two where there's a little bit of a lull in the business, because the contracts that have been awarded do take normally 2 to 3 years on the new big greenfield projects. And so that's a long-winded answer on Subsea 7 today. In the meantime, Subsea 7 buys back their own stock, so therefore they have an owner manager. So there's a lot of attributes that can always continue to be the case, but and have instituted a dividend. It's a regular dividend. There's a statement on the part of the company that we think the future looks different than what it has been in the past, and the market's ignoring those facts.
Great, thank you. So our next question is there any political risk associated with any of the themes, and can they change the rules on us? What are the tail risks that might upend what seems sound logically? And then I'm adding this part myself, but maybe you want to talk a little bit about the monetary versus fiscal policy that the U.S. has implemented over the last decade or so, and how that's changed.
Wait. You grouped together two.
Sorry, I'll just repeat their question, and you can answer that one, which is that: are there any political risks associated with the themes, and what tail risks might upend what seems sound logically?
There's uncertainties in any business. Can something happen? So one of the businesses that so the energy business, right? Our investment, Subsea 7, Tidewater, do business all around the world. And so there are many different countries, many different governments, many different policies that can happen. And so there's always risk. And of course, those risks have manifested themselves today. And that's been one of the negatives of the business. So, what's going on in Nigeria is a place that has been a negative and a detriment and has held back the opportunity set for both Subsea 7 and Tidewater, because you haven't seen development in those places, even though there are projects that are economically logical, but because of the terms and conditions and because of the conditions in those countries, they haven't happened. The same thing is true of Angola. Of course, what you really have seen in the last 2 years is Angola has identified the fact that production is in decline, that therefore they're looking to institute new policies that encourage new activity. So therefore, they have made the place much more hospitable to new capital and new investment. And that's what you do see. You see a pickup in opportunity. The same thing has been hoped for in Nigeria, and the government continues to work on. And eventually, I think we'll actually figure a way to do things that will encourage new capital inflows, because that's what you want. You want new capital inflows. The problem you have is more when you have existing capital you've already invested and you have production, that someone starts to change the equation on you, because they can do that with less ramifications. If they want your capital and need you to invest more money, therefore they're less likely to kind of upset the apple cart and change the economic situation. So we think the demand for pretty much every country and their hospitality and interest in bringing in capital for new development mitigates the risk they're going to change the rules anytime soon that would hurt new capital inflows that they're looking to encourage.
Great. If you don't mind, Bob, I just would add one quick thing to that, which is specifically in North America, we've seen some changes politically that have actually kind of helped some of our businesses, whether it's changing potential manufactured housing rules, or it's actually doing real monetary policy, which you spoke to earlier in the presentation. So there are some political benefits that we're seeing, and we did see obviously some big political shocks in the last 2 or 3 years that our companies were able to weather pretty well. But anyway,
obviously, the last number of years, people have complained about U.S. government policy hurting oil and gas business. I actually think that's distorted and blown out of proportion. I think there's plenty of places in North America to drill, and if there's the interest in doing it and there's an economic opportunity, there's clearly an economic opportunity. It's not being constrained by government activity and government regulation. I think that's substantially overplayed as kind of an issue that confronts the industry.
Excellent. Thank you.
Okay, so we're coming up on 4 p.m. here, so we do have some other questions that we weren't able to get to, but we'll make sure that we reach out to everyone who submitted these questions, and hopefully we can answer them to the best of our ability one-on-one.
And one last question is, will there be a recording of the webinar available? And we do hope to have that available shortly afterwards.
So again, let me thank everybody who dialed in, listened in. I hope I wasn't too much of a waste of time. I hope you find it valuable. I'm sure you probably have questions, maybe some of those you didn't ask here. I love the opportunity to talk to you. If you want to follow up, give me a hard time, question some of the things I said, try to get better understanding as to why I say it, and what our conviction is on it. I welcome those calls. Thank you very much.